Well, hello, everybody, and welcome to the Middle Class Investor. This is Seth Martin, your host. It is about 6 o'clock on Sunday, February 10th, and welcome back. Welcome back to another session. We'll get to the charts in just a second. I've added this little introduction page. Mainly, it's a disclaimer page, and it's not as comprehensive as some people have. I just want to make sure that everybody knows that trading and investing involves risk and potential loss of principal. Examples given in these webinars are neither offers to buy or sell securities. Losses can, will, and do happen. It's the nature of putting capital at risk. So you're encouraged to do your own research and consult a broker dealer for questions about your specific financial situation. So, bottom line is I just don't want anybody coming back and saying, hey, he told me to do this, and deciding to sue me for money I don't have. So that's all. All right, so here's the S&P 500. We're going to zoom in a little bit here and look at this past week. And as you can see, we've got what's referred to as a doji. And you can see we got price kind of stalled out right there at that 200-day moving average. That's that red line right here is the 200-day moving average. And dojis are kind of happen at the end, usually at the bottom of trends, either bottoms or the tops of trends. And if you think about it, let's say I'm going up in a trend. And remember how we always talk about the first move up or down, and then we have a counter trend move to that move. Okay. Well, if you zoom out, if you look at this from far away, this formation right here, this W formation, looks like a doji on a weekly or daily chart. Okay. So a lot of times these can be, that's why they're at the tops or at the bottoms of trend, depending on which way the dominant trend direction is. But in fact, we can zoom in on the, in fact, we will. We're going to look at a 60-minute chart here a little later. I'm going to show you there's 5 waves, and then we're in the middle of an ABC correction back up. So just wanted to point that out, but it's also interesting that it's happening. Oh, I thought that was the 200-day moving. I'm sorry, I'm not on a daily chart. So let me get on the daily chart, and you can see where the 200-day moving average. So it turns out that the 30-week moving average and the 200-day moving average are the same, roughly the same spot on the chart. So here's the 200-day moving average right here, that black line. And you can see the market reversed right there at the 200-day moving average and started to roll down. In fact, we got a gap. So it could be that we're going to fill this gap. A lot of times gaps get, once they happen, they get filled. So we could see the market rally back up into here next week before rolling over and starting to the downside from this counter trend move. Now, some people are saying, well, looks like a 5-wave move here. Here's 1, 2, 3, 4, 5. And I agree it does, especially this daily chart looks like a 5-wave move. And that's kind of Elliott wave, so that sometimes that happens. We'll look at it on my MT predictor chart in a minute. And you can see this looks a little bit more complicated than a 5-wave move. So we're calling it counter trend. Now, if this market takes off, in fact, if it goes much higher than this, we're going to have to rethink the fact that this is a downtrend. But for right now, that's what we're calling this move up here is a counter trend to the dominant trend down. And that means probably, unless you're pretty nimble in your market positions, you probably should be on the sidelines. But that's up to you. Like I said, it's your money, your decision. It's just sometimes, it helps to go someplace and kind of talk through what somebody else sees. Because sometimes, I know when I first started out, all I saw was just, stuff jumping up and down. I really couldn't make sense of what was happening. The market went up, it went down, but I couldn't really, I don't know, I just couldn't make sense of it. So sometimes it helps to go in and, at least until you can learn to see what you see, understand what somebody else sees. Okay? All right. Let's look at the 10-year Treasury. Well, let's look at volatility. We haven't looked at volatility in a while. So volatility has been crushed here after this spike up in volatility. I mean, it's just, if you were selling volatility, man, you did pretty well. Down by 50% or more. The Treasury yield. We've been talking about the Treasury yield ad nauseum, really, and we're still kind of flopping around in this zone around this support area, and made a lower low. In other words, this was the previous low, and this low came in a little lower. Now, remember what I just said about dojis. This is a doji, so it could be that we've had a little move off this, and we're pulling back, and the next wave up is starting. So we'll see. This also looks kind of like 5 waves, or it could be an ABC, kind of X, and then C. So anyway, it could be that the 10-year Treasury could be taken off right here. And of course, that means you don't want to be in bonds. So just beware of that. All right, 13-week Treasury. It's been consolidating here for a while, which is, I don't know. It was consolidating for a while back in here, and then the Fed started talking about not raising rates. So I don't know. I just think it's interesting that the market consolidated first, and then the Fed started talking about not raising rates anymore. But as I've said before, if this starts taking off to the upside, the Fed will be raising rates. You can count on it. They are not going to risk their reputation or their models. It's really their models. They believe in their models so much, and their models really are not that great. They're not. It's not like the Elliott wave model. Their models are many variables, and there's just a lot of stuff, a lot of what I call jello moving on the plate. Actually, it's Gary Kaltbaum's saying, a lot of jello moving on the plate. So I don't know. Bottom line is the Fed follows rates. They don't lead rates. All right, let's look at some of the countries. Here's Germany. Just continues to fall. I mean, all these are going to look kind of similar. Japan. Looks like wants to go lower here. The UK. The UK looks the strongest out of all the market. Well, our market looks pretty strong. But now we're coming into some resistance here in the UK. You can kind of see it here. This whole formation starts here and it goes up to here and it kind of chops around in here. So there's a lot of resistance right here where the FTSE's starting to run into. And in fact, look, it kind of rolled over, started going lower. So the FTSE may be done for the time being. We'll just have to wait and see. Anything else we want to look at there? Swiss franc? Nah. All right, let's switch over to the Thinkorswim charts, and let's look at, that's the S&P 500. Let's look at oil. Oil had a really hard sell-off here, and then it's kind of rebounded a little bit. Looks kind of counter trend, right? This looks impulsive, like 1, 2, 3, 4, 5 maybe, and we're going to get an ABC correction up. So maybe oil goes a little lower, and then we get a rally. But I think oil could possibly be in a larger consolidated triangle that's just going to trade sideways between here and let's say 33. Actually less. It shouldn't go lower than this. Let's say 38 to 72. So it could trade in this range for a while. Let's go ahead and look at silver and gold. We drew this a while back. We're expecting silver to kind of take this path up. We had finally had a pretty good several weeks with some pretty good moves to the upside and then some slight pullbacks on lower volume. Gold looks a little stronger. It's just pattern in general looks stronger. And depending on whether this is a triangle, which you can kind of see here, you can kind of see this moves over here and this moves over here, or whether or not this is kind of the whole thing is B right here. So A, B, down to here and then C. We could see oil get up here in the 1450 to 1500 area, probably off this pivot here. So if you haven't bought any gold, I don't know that I would necessarily do it right here, but you may have to wait for the next move down in gold to pick up some gold. Let's see. Let's go to the euro US dollar. So I traded this a couple times last week, and it's trying to kind of pick this bottom. Looks like we want another low here. Looks like this could be A, B, C, in which case we should be pulling back here to this 112.78 area. In fact, let's zoom in on this just real quick. See if we can see something different. Yeah, you can kind of see this looks like maybe an A, B, C, and we're going to have a C into this area here. So we'll keep looking for that. I've been trying to get into the euro. I've gotten in a couple of times with some small losses, but my belief is the euro is going to go all the way up here to 1.185 or 1.19, somewhere in there. And I definitely want to be in the euro when that happens. All right. Let's see. Somebody's riding a motorcycle or something outside my house. What have I not covered? Euro, gold. Okay. Maybe covered most of the stuff there. All right. Let's look at the SPY. Well, hold on. Let's go ahead and talk about this real quick. One of the things I wanted to point out is Ray Dalio has this thing called how the economic machine works, and it's pretty good. He covers debt, short-term debt cycles, long-term debt cycles, productivity. Now, you got to keep in mind this is kind of a Keynesian view of the economy. I mean, you don't ever hear him say anything about production or anything like that. You just hear him talking about spending. One person's spending is another person's income and stuff like that. These are very Keynesian kind of ideas. But the whole discussion around debt, I think, is very, very good. And he talks about short-term debt cycles and then longer-term debt cycles. And he explains how that happens and what usually the result is. So go to YouTube and check this out, How the Economic Machine Works by Ray Dalio. Ray Dalio spelled D-A-L-I-O. Dalio. Okay? So I wanted to point that out because I thought that was pretty good. It's about 30 minutes. It'll take you about 30 minutes to watch it. All right. What I want to do is I want to look at this ES here, this shorter term, this 60-minute chart, because I thought this was interesting. So last week, this is a 60-minute chart. That means each bar that you see here is 60 minutes, okay? So last week on the 5th, we kind of topped out toward the end of the day, right at the close. Market ran down the following week on Monday, and then rallied up, and then ran down pretty hard, and then ran up, and then back down. So what you see here is a 5-wave move. 1, 2, 3, 4, 5. Now this could be a correction in which this whole 5-wave move is A, and we're going to have B up and then C down. Or this could be, like I said, the 200-day moving average was right here, so this reversed right at the 200-day moving average. Okay, so let's just see where maybe a two might be. So let's say back up in wave 2, go from high to low. So wave 2 is right here. Now we've already satisfied the minimum wave 2, but notice we don't have kind of an ABC. So what I'm expecting next week, and by the way, let me just say this is almost never perfectly accurate, but we could experience the remainder of this pattern down on Monday, and then maybe the end of Monday and part of Tuesday back up, maybe to the 2720 area on this is the E-mini futures. In which case, if that happens, this would be a wave 2. Okay, after a wave 1 down, this is wave 1 right here, wave 1 or A. And if this is a 2, of course we know 3 comes next, and could be a doozy come the end of the day Tuesday or maybe Wednesday. So keep your eyes peeled for that. Again, we might see something. We've already seen kind of the move up. We might see a move down and then move back up. So we got another down-up sequence, at least on the S&P 500 and the Dow. So we'll be looking for that. Also on the S&P, on the SPY, this is the much longer term chart, where this is the high back in September, October. And so this was that whole January move down. We've had kind of another half move up, but notice where it is, wave 2 or B. So, and this is a weekly chart. So it could be that it could chop around here for another 2 weeks as it traverses this way and then starts to head lower. But I think these are good chart indicators. I mean, I think they're good signposts that you want to read when you see them. Let's see what else we have. Let's look at the EU or the euro. So this is euro US dollar. Of course, several times I've been trying to get in here, but it's kind of keeps just chopping sideways. But the euro, we're imminent. I mean, it's imminent that this is going to bounce and start heading up. The reason you see so many ins and outs there is I just don't want to hold it. I don't want to have a lot of risk. I'd rather, lose 4, 5, 6 times in a row if it's a small amount of money, than lose big once. You just don't feel, it doesn't feel good when you lose a lot in one trade. So I've been kind of in and out, trying to pick the bottom here, so to speak. But it could be that we're going to head down just a little lower this week, off to down to maybe this area, slightly lower. And then if we do, then we should rally up north of this pivot here. So we can put that on DP. So we would look for a move from here all the way up to here, which is a pretty good move. Pretty good move in the Forex market. All right, let's see what else we got here. That's really about it. I don't want to take a ton of time because we haven't quite got the kind of moves that I would like to see to feel real comfortable about the bear market. But it's possible that we're going up to new highs. I mean, if you go back and look at Let's go back to the profit chart and let's look at the S&P 500. And let's look at 10 years. So, it's possible that this is kind of a 1, 2. This is all, this is 3, this is 4, and then 5 up. But it just doesn't look likely to me. I mean, this 4 right here looks proportional in both time and size to this 2. So I'm sticking with the fact that we're in a counter trend move and probably very, very, very close to the end of counter trend move. So we should know after a few more cards come out of the deck next week. So we'll be sure to bring all this up next week and talk about where we think the market's going from here. Okay? All right, everybody. Thanks for coming in this week. This is the Middle Class Investor. Come back next week and we'll do it all over again. Thanks. Bye.